It's now time for us to get below the line. We've looked at gross income, above the line deductions to AGI or adjusted gross income. Now we look at a couple of below the line deductions. Here, the first one, you have an option as a taxpayer to take a fixed dollar standard deduction or itemize your deductions, wherein you fill out a Schedule A. And I'm sure you remember my mnemonic. Mike takes interest in charity and casual outings. On page 61, we're looking at deductions from AGI that we see on page 2 of form 1040. Look at line number 8, where we've got highlight standard deduction, circle all, and highlight itemized deductions, which we see on, put a box around Schedule A. On line number 9, we've got highlight the qualified business income deduction. Turn to page 62, where we've got highlight standard deduction, again circle all, and highlight itemized deductions on Schedule A. On this page, we're talking about highlight standard deduction. For the year 2018, standard deduction for highlight single taxpayers is $12,000. Same number for married filing separately. For head of household, the standard deduction is $18,000. And for highlight married filing jointly or for qualified widow or widower, the standard deduction is highlight $24,000. There is underlined additional standard deduction which is available for elderly, that's above 65 years of age, and or blind. We are looking at deductions from AGI, below the line deductions. The first one here is standard or itemized deduction. And you as a taxpayer will take any one of these, and naturally you want to take whichever is higher. Now, if your itemized deductions are higher than your standard, then you'd want to fill out a Schedule A, where you'll have all these 6 items of deduction. And let's look at all of them on the other side of my board. So we're talking about Schedule A, itemized deductions, which are deductions from AGI, below the line deductions. And here you have a list of 6 items. Mike takes interest in charity and casual outings. Let's look at the first one, medical and dental expenses. So these are medical and dental expenses for yourself, your spouse, and your dependents. Now, the deduction that you claim here on Schedule A is the unreimbursed portion of your medical and dental expenses. So if you recall, when we spoke about wages and salaries, we said if your employer reimburses your medical expenses, it's a non-taxable fringe benefit. But if the employer does not reimburse, it hits your pocket. And that is where you put it up here on Schedule A. If you've received some reimbursement from the insurance company, you reduce that, because here you'll have only the portion which has not been reimbursed, not reimbursed by your employer and not reimbursed by the insurance company. Now, we have a limitation for these medical and dental expenses. From 2019 onwards, you are allowed to deduct medical and dental expense only if they are in excess of 10% of your AGI. So let's say as a young, fresh CPA, you start working, your AGI is $80,000 and your unreimbursed medical expenses for the year are, let's say, $9,000. So your AGI is $80,000, your medical expenses, unreimbursed portion, this is $9,000. Now the deduction that you're allowed on Schedule A is in excess of 10% of your AGI. So 10% of $80,000, your AGI is going to be $8,000. And the deduction that will be allowed here is only the expense that's there in excess of $8,000. So though you've spent $9,000 unreimbursed medical expenses, you will be allowed deduction for only $1,000. On page 63, highlight itemized deductions. And right there, for personal expenses, we know that for itemized deductions, we've got Schedule A, and our mnemonic here is Mike takes interest in charity and casual outings. Let's start with the first item, M for medical expenses. Here we have a word of caution from the IRS. It says underline, do not include expenses reimbursed or paid by others. On line number 1, we've got medical and dental expenses. On line number 2, it says enter the amount from form 1040, line 7. Now, you would want to go back to form 1040. Look at what do we have on line 7. You'd realize line 7 of form 1040 is right AGI or adjusted gross income. Line number 3 says multiply line 2 by, put a box around 7.5%. So line number 1 is the total medical and dental expenses, which are unreimbursed expenses. Line number 3 is 7.5% of AGI. Line number 4 is subtract line 3 from line 1. If line 3 is more than line 1, enter 0. Therefore, we realize that medical expenses allowed as itemized deductions is only if they are right in excess of 7.5% of AGI. And this is a threshold for right 2018. For 2019 onwards, the threshold will be right greater than 10% of AGI. Within bracket, right 2019. Turn to page 64 and highlight medical and dental expenses. So we're looking at medical and dental expenses. Put a box around greater than 10% of AGI from 2019 onwards. We're looking at expenses which have been highlighted paid during the year by underline cash or check or charged on credit card. Circle less and highlight any reimbursed portion by employer or insurance company. The deduction here is allowed for expenses of self, spouse as well as dependents. The expenses which are deductible include highlight prescribed drugs and medicines. Highlight medical service includes hospital, doctor or dentist fees. Highlight travel cost for Medicare. Highlight stop smoking programs or highlight weight loss programs only if the purpose is to treat obesity or other disease. Highlight surgery. It includes plastic or cosmetic surgery done to cure disfiguring injury, illness or birth defects or LASIK surgery. Highlight medical, dental, hospital, insurance premiums. Next, highlight medical goods or devices like false teeth, eyeglasses, hearing aids, etc. Highlight costs to install medically prescribed facilities or remove structural barriers at home. And this is for physically handicapped, includes like swimming pool, elevator, etc. But the taxpayer needs to deduct any increase in the house fair market value as a result of such an installation. On the next column, we've got a bunch of non-deductible expenses. Put a star there. Underline non-prescription drugs which are not deductible out here. General health improvement costs like underline health club membership not allowed. Underline personal hygiene at ordinary personal expenses again are non-deductible. Underline expenses for household help non-deductible. Underline cosmetic surgery if it's done to improve appearance for you to get to Hollywood non-deductible. Accident or disability underline earnings insurance again it's non-deductible. Underline life insurance premiums are non-deductible. And then underline funeral and burial expenses. Once again, non-deductible expense. Now, when we spoke about deductible expenses, we said you could deduct expenses of self, spouse, and dependents. Now, I want you to draw an arrow from dependents down on the next sub-bullet, which has got a note which says that to claim medical expenses of circle dependents, only few of the IRS jar tests need to be met, which means that you can deduct medical expenses even for individuals who you are unable to claim as dependents due to failed income test or failed joint return test. Which means that for deductible medical and dental expense purposes, we'll only look at a few of the IRS jar tests. We'll continue to look at highlight related test, whether the dependent is highlight related or lives with taxpayer for the whole year. We'll still look at highlight S or support test, where the taxpayer needs to provide highlight over 50% support. We'll continue to look at highlight residency test, where the dependent needs to be highlight a US citizen or resident of US, Canada or Mexico. Basically, what we are saying here is do not worry about income test. Do not worry about joint return test. So the requirements here for dependents is right lesser than the dependency requirements. Basically the IRS jar requirements that we have for right qualifying child or qualifying relative. The next item on our Schedule A is taxes. Here we are looking at deductions for state and local taxes that you've paid. So you could claim a deduction for state and local income tax or state and local sales tax. You could get a deduction for the state and local real property tax that you pay for the house that you own. You can claim a deduction for personal property tax. Let's say the amount of state and local taxes that you've paid on your car registration. You're also allowed deduction for other taxes, and the other here includes the foreign income tax. For foreign income tax, you could either, of course, claim a deduction here on Schedule A, or even better, we will talk about that when we're doing tax credits. We'll say ACE equals foreign business winner, and here you could claim a credit for the foreign income tax that you've paid. So for the foreign income taxes, either you get an itemized deduction or you take a tax credit. Of course, mostly tax credits are better because they are a dollar for dollar reduction of your taxes. Now note, you can never deduct federal income tax on the federal income tax return 1040. The purpose of 1040 is to calculate your federal income tax. You cannot be deducting the federal income tax out here. I mean, if you do something like that on Microsoft Excel, this would be called a circular reference. Let's get back to page 63. We've got Schedule A for itemized deductions. And the second item out here is taxes. So on line number 5, highlight state and local taxes. So here we are looking at state and local, underline income taxes, circle or, and underline general sales taxes. So you could either claim income taxes for state and local or sales taxes for state and local. On line 5B, we've got state and local, underline real estate taxes. 5C is state and local, underline personal property taxes. Line 5D says add lines 5A through 5C. And then line 5E says enter the smaller of line 5D or put a box around $10,000. So basically, the deduction that's allowed for state and local taxes is right up to 10K. On line number 6, we have highlight other taxes. And here you could include, right, foreign income taxes. And then for this item, we've got line 7, which says add lines 5E and 6. The total of state and local taxes and other taxes, which could be foreign income tax. Turn on to page 65, where we're looking at itemized deduction for highlight taxes paid. So here you could deduct, right, state and local taxes. Other taxes like, right, foreign income taxes, right, but not federal income tax. So we're looking at deduction for taxes which are highlighted paid during the year, right, by 12/31, so by December 31st. If there are highlight any refunds or recoveries of tax payments itemized in prior year, they should be included in gross income as per the tax benefit rule. And we've seen that when we discussed gross income. So right there, sir, you owe, and we know these refunds are circle R of sir. On the next bullet, highlight deductible. So what's deductible here is highlight state and local taxes. But there's a limit. Put a box around up to $10,000. For state and local taxes, you can either deduct, highlight income tax or highlight sales tax. So draw arrows and write deduct any one of two. You can also deduct, highlight real property tax, where the taxpayer is underline owner of property. Underline joint tenancy is okay and the taxpayer is legally obliged to pay. So you can't be paying real property tax for somebody else and claiming it on your Schedule A to Form 1040. Underline apportion taxes between buyer and seller in the year of purchase and sale. Couple of lines below, do not, circle not. So do not include, underline assessment tax on improvements like street or sewer or sidewalks, which should be added to the property basis. Next, we have deduction also allowed for, highlight personal property tax paid for state or local governments. And besides the state and local taxes, you could also claim a deduction for, highlight foreign income tax. But for foreign income taxes, you can write either claim a deduction or tax credit. And we're going to talk about tax credit for foreign income taxes when we're looking at, right, ASDS equals FBW. So that's foreign business winner, and circle the F of FBW because that's foreign income tax credit. So once again, for foreign income tax, either claim a deduction or tax credit. Can't get both. Next, we are looking at taxes which are, put a box around non-deductible on Schedule A and put a star there. The first one on this list is underline federal income tax. You can never deduct federal income tax on the federal income tax return. Next, you have federal, state or local, underline estate or gift taxes. Underline any social security taxes and other federal employment taxes paid by the employee, or underline self-employment taxes paid by the self-employed individual, or underline business taxes which are deductible on Schedule C, or underline rental property taxes which are deductible on Schedule E. Is note, Schedule A is for personal expenses. If it's a business expense, goes into Schedule C. If it's a rental property expense, goes into Schedule E. The last one here, underline foreign personal or real property taxes. Note that state and local real property tax as well as personal property tax is deductible. But foreign real property tax or foreign personal property tax is non-deductible.
We're still on Schedule A, where we're looking at itemized deductions. And our next item is interest. So let's say you've taken a home mortgage loan to buy, build, or substantially improve your home. Now, the interest on that home mortgage loan is deductible on Schedule A. So, interest on home mortgage, or let us say you've borrowed money to invest money. From your investments, you're earning interest income, you're earning dividend income. On the money that you've borrowed, your leverage, you're paying out interest expense. We call this investment interest expense, which is also deductible on Schedule A. However, note that you can deduct the investment interest expense only to the extent of investment income that you have as part of your gross income. Let's say your earnings from interest and dividends on your Schedule B. Back on page 63, we are looking at the third item, which is interest. Line number 8, highlight home mortgage interest. So this is interest on a mortgage loan used underline to buy, build, or improve your home. On line number 9, highlight investment interest. So line number 10 here says add lines 8E and 9, all the interest you paid allowed as an itemized deduction on Schedule A. Turn on to page 66 and on the top highlight interest expense. The second bullet here, highlight deductible. Right, number 1, highlight home mortgage interest, and this is on acquisition indebtedness for your first or second home. This is for a loan of up to, put a box around $750,000. Highlight secured by the home and highlight used to buy, build, or substantially improve the home. On the next sub-bullet, write number 2 and highlight investment interest expense. And this is underlined limited to net investment income. Underline any unused investment interest expense may be carried forward indefinitely. Underline interest expense to purchase tax-free bonds which are tax exempt is non-deductible. Put a box around non-deductible items here. So these are interest expense which are non-deductible on Schedule A. Put a star there. Underline personal or consumer interest. So this is unsecured personal loans, life insurance loans, credit card interest for personal purchases, interest on personal property purchased for personal use, for example, an auto loan, or interest on underpayments of taxes. What's also non-deductible is any underlying prepaid interest. So the rule for prepaid interest is that you need to allocate over loan term even if you're a cash basis taxpayer. So write the exception number 2, and we saw that right on Reg 1, page 19. And next, underline educational loan interest. Now, education loan interest is an above the line adjustment. We know this is the S of wishes, the second S, which was the student loan interest.
You're a responsible citizen who believes in giving back to the community. You're committed to causes to make this world a better place to live in. Uncle Sam is really impressed with you and allows you to deduct your gifts to charity as an itemized deduction on Schedule A.
Back on page 63, we continue to look at our Schedule A, and we are now on our fourth item, which is gifts to charity. Line number 11 is gifts by cash or check. Line number 12 is gifts by other than cash or check. And for gifts to charity, there's a limit of right up to 60% of AGI. Now, any non-deductible portion, any non-deductible charity can be carried forward. So on line 13, you have carry over from prior year. Now note that the carry over is allowed right up to 5-year carry forward. And line 14 is the sum of line 11 through 13. Turn a few pages to get to page 67, where we've got highlight charitable contributions and put a box around up to 60% of AGI. We're looking at charity highlight paid. So either paid by cash or check or charged on credit card or property that's contributed. Highlight for property, deduct lesser of tax basis or fair market value. Now there's an exception. For non-business investment or underline long-term capital gains property held for over a year, always underline deduct fair market value. Now for all charity paid, you need to subtract or highlight less any benefits received from charity. On the next bullet, highlight deductible. So what's deductible here is highlight charitable contributions to qualified domestic organizations. Now, if there are benefits received from the charitable organization, only the excess contribution over underline fair market value of benefits is deductible. So basically, we are doing right less benefits received from charity, and draw an arrow to this line that we read on the previous bullet. You're also allowed to deduct highlight out-of-pocket costs for volunteer services like transport from home to the site. But there is right no value for taxpayers' time. You're also allowed deduction for out-of-pocket unreimbursed highlight costs up to $50 per month to maintain a student who's not a dependent or relative highlight in the taxpayer's home based on a written agreement with a qualified organization. On the next bullet, we've got all that's put a box around non-deductible and put a star here. This is often tested on the CPA exams. The first one out here, contributions to underline individuals or underline non-qualified organizations. For example, a donation to a needy family. What's also non-deductible is contributions to civic leagues, social clubs, underline foreign organizations political organizations, communist organizations, chambers of commerce, or labor unions. And we've already mentioned above that any value for the taxpayer's time or services is again non-deductible. Let's move on to the next bullet and underline maximum allowable deduction is 60% of AGI. And underline for long-term property, the limit is 30%. Any underline excess amounts which you haven't been able to deduct because of these limits maybe carry forward up to 5 years. Let's make a little note for donations of property. Now, if the taxpayer is donating short-term capital gain property, then the amount would be lower of basis or circle or fair market value. But if the taxpayer is donating long-term capital gain property, then the value would be at fair market value. And we've just discussed that for long-term capital gain property, 30% of AGI limit also applies. And draw an arrow to connect this on the last bullet.
You own a lovely beach house which has unfortunately been destroyed by a hurricane. And this hurricane has been declared a federal disaster. Your casualty loss can now be claimed as an itemized deduction on your Schedule A, subject to certain limitations.
Back again on page 63, we're looking at Schedule A, line number 15 for casualty and theft losses. So this line says that you can deduct casualty and theft losses from a federally declared disaster. And the deduction for casualty and theft losses would be only if these amounts are in excess of 10% of AGI. Turn on now to page 68 and highlight casualty and theft losses. These losses, as we discussed, are deductible only if, put a box around, greater than 10% of AGI. Highlight the loss here is the drop in fair market value. And this loss is underlined limited to the asset's tax basis. We are looking at unreimbursed portion of the loss. So circle less and highlight insurance or government reimbursement. And then circle less and highlight $100 per event. Now, casualty and theft losses are highlighted deductible only when there's a loss of underlying personal use property which is attributable to highlight a federally declared disaster. If personal casualty gains are greater than losses, so if you have a casualty gain instead of a loss, treat as capital gain. On the next bullet, put a box around non-deductible. Underline repairs in connection with the damage. Note that the drop in fair market value is already deducted. What's also non-deductible is underline casualty insurance. Note that though casualty losses are deductible, casualty insurance is not deductible even if a casualty is actually incurred during the year.
Last Jan, you went to Vegas with your girlfriend and you won $500,000, $500,000 on you. You're really happy and excited. Even though you broke up with your girlfriend towards the end of Jan, you traveled back again to Vegas in Feb, this time alone. But the Feb trip wasn't a great one. The lady luck was missing. You lost $600,000. So guys, the $500,000 that you won gambling winnings in January is other income as part of your gross income. The gambling losses, the loss that you had in Feb is an itemized deduction. It's deductible as other itemized deductions. But your gambling losses, the losses that you can deduct here is only to the extent of gambling winnings that you have in your gross income. So if you have reported gambling winnings of $500,000, the money you won in Jan, you can deduct gambling losses only to the extent of $500,000. So though you lost $600,000 in Feb, you will be able to claim a deduction, an itemized deduction of only $500,000.
On page 63, again on our Schedule A, we are looking at the last item for itemized deductions. And this one is other itemized deductions. Check out line number 16, which says list the type and amount of these other deductions. And a good example of other itemized deductions is gambling losses. Turn on to page 69 and highlight other itemized deductions. And what's highlighted deductible here is gambling losses, which may be deducted, underline, only to the extent of gambling winnings included in gross income.
We've been looking at Schedule A, itemized deductions, which are below the line deductions. And we have a lovely mnemonic. Mike takes interest in charity and casual outings. All the items of deductions on Schedule A. Now, I want you to note that on Schedule A, we only have personal expenses. So let's say when we talk about medical and dental expenses, these are personal expenses, personal taxes, the interest that you paid on your own house. Now, if you have business expenses, let's say you've paid business taxes, you've paid interest on business loans, the loan that you've taken to start your sole proprietorship concern, all those business expenses will go into Schedule C. If you have incurred expenses on your rental real estate property, let's say you have a property which you have given out on rent, rental income goes to Schedule E. Now, on that property, when you pay taxes, that's an expense on Schedule E. On that property, when you pay mortgage interest, that's an expense on Schedule E. So guys, what you have on Schedule A is all your personal expenses. If it's business expenses, put it on Schedule C. If it's expenses related to rental property, put it on Schedule E. If it's, let's say, expenses related to your farm, put it on Schedule F, farm income.
Let's get to page 63 for one last time. And on this page, we've got Schedule A, and we know Schedule A, you got itemized deductions, where we're looking at Mike takes interest in charity and casual outings. Let's make little notes at the bottom of the page. Right, note. Personal expenses are the expenses which are deducted on Schedule A. So all these 6 items are personal expenses. Now, if there are any of individuals business expenses, they go on Schedule C. If the individual has rental property which he or she has put it out on rent, and there are rental expenses, that's Schedule E. If the individual is running a farm, growing crops, and if there are farm expenses, that's Schedule F. So this note will basically help you understand that it's only the individuals or the married couple's personal expenses which are coming in here on Schedule A.
From your AGI, after deducting standard or itemized deduction, the next below the line deduction is QBI deduction, or qualified business income deduction, which leads into your taxable income. Now, QBI deduction or qualified business income deduction was introduced by the Tax Cuts and Jobs Act, where the key agenda was to encourage businesses, the B of QBI, and to make America great again. So if the taxpayer has qualified business income on Schedule C, the taxpayer is running a sole proprietorship. Or if the taxpayer has qualified business income on Schedule E, so qualified business income on Schedule E could be income from partnership or income from S corporation. On all these qualified business income, the taxpayer is allowed up to 20% qualified business income deduction as a below the line deduction from AGI.
On page 70, we've got highlight qualified business income or QBI deduction. And this deduction is highlight 20% of qualified business income from a qualified trade or business. The couple of additions, couple of plus signs, put a box around those. So it says plus 20% of underlying qualified REIT, that's real estate investment trust dividends. And then it says 20% of underlying qualified PTP, that's publicly traded partnership income. On the next bullet, it says QBI deduction is applicable for highlight qualified business income, which could be from highlight sole proprietorships or highlight pass-through entities like partnerships and S corps. Move to page 71, where we've got highlight QBI deduction limitations. This applies only if the taxable income before the QBI deduction exceeds certain dollar thresholds. This limitation is based on the amount of highlight W2 wages paid as well as highlight qualified property held by the trade or business. Also, if the business is highlight a specified service trade or business, SSTB, it's going to be excluded from the qualified business income if the taxpayer's taxable income exceeds a certain threshold. For example, right, CPA firm, a law firm, or a marketing agency. So if the taxpayer's taxable income is highlighted up to threshold, then the SSTB income is highlighted fully eligible for the QBI deduction. But if the taxable income is highlighted at the phase-in range, then the SSTB income will only be highlighted partially eligible for the QBI deduction. And if the taxable income of the taxpayer is highlighted above the phase-in range, the SSTB income will be highlighted not eligible for the QBI deduction.